Good morning, hello and welcome to a fresh new edition of Bazaar Morning Call. It's a Friday, the last trading session of the week. We're coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Sonia and Nigel. Good morning, guys.
Hi, morning. How are we feeling about Friday?
Always good.
Always the best feeling. I thought that next week was the truncated week, but then I realized it's the following week. So my enthusiasm got dampened a little bit.
Off a little bit. But, well, it is a Friday, so let's kickstart things with a quick run-through of what you need to know as we begin another trading session. I mean, it's been tough. For the last 4-5 trading sessions, I mean, the market's been down and out. Although yesterday there were some signs of life. I'll come to that in just a bit. But let's pick up from where US markets have handed off the cues to us. So the Nasdaq was up about 0.75%. And the S&P ended mildly higher as well. There was NVIDIA, which reported results, and there was a big rub-off impact in the US tech sector. And I think general level of enthusiasm. I looked at the NVIDIA broad numbers. Is just a P multiple upgrade. Actual earnings have not been upgraded for the company, but people are now assigning a higher P multiple because of the AI opportunity which NVIDIA seems to poise to harness. But that was one name. You had other earnings as well from the tech space. Numbers have not been all that bad. I mean, I'm talking about the last overnight session. In terms of price action, you had equities, as I said, which ended higher. The 10-year sold off about 4 basis points. This is the US 10-year. It ended at about 3.88%. The US 2-year, by the way, was absolutely flat. But the 10-year came off, the 5-year was down, and the 30-year was lower as well. So across majority of the yield curve was lower. The dollar index, that is, hit a high of 104.8. And then it came down quite sharply to about 104.51. Now, this gives hope. But one should not go read maybe too much into it at this stage because just like last Friday, if you remember, we had a big reversal from the highs for the US 10-year and the dollar index, but that did not help from both those things pushing higher for the majority of this week. We need more price action saying, well, things are cooling off. In any case, the dollar index remains quite far away from levels needed to fructify into a bullish outside month, which is a very powerful signal. I mean, if that were to materialize, I mean, you're basically looking at much higher levels on the dollar, which is not the case. The Nifty ended lower, but we ended about 100 points off the intraday low yesterday. That's the close, 17,511. The budget day low is still not very far away. I mean, at the low point yesterday, the Nifty was about 100 points from the from the budget day low, 17,353, and I think that must hold in case of more downsides. The Bank Nifty ended up by 5 points. So it was a positive daily close, which is good. The banks, of course, have been a much weaker part of the market as compared to the Nifty. The Bank Nifty ended 300 points off the low as well. Yesterday's low on the Bank Nifty was 39,600, and I think that must hold in case of more selling, more downside. So you've got clear markers, the budget day low on the Nifty and 39,600, which is the low on the Bank Nifty from yesterday. I said this yesterday morning as well, that nothing happens in a linear, straight-up fashion. The market sold off on the Nifty some 650 points in 5 sessions, about 1,400 points on the Bank Nifty in 5 sessions. So, market will test for how strong the bounces are. But I think, if you're trading, you let the market tell you, both on the Nifty, the Bank Nifty, etc., you let the market tell you that it wants to base out. And that is a process. That is not a one-day price action thing. You could look for action in specific stocks, and there is enough happening. We can talk more about that. But on the indices, you want the market to tell you that it's in the mood to give you a little bit more of sustainable bounces and not bounces which get sold off very aggressively like the ones we've had. Guys, hi.
Absolutely, hi. And there's not been a clean stretch so far, right? It's been very volatile the last few days, ups and downs, intraday sell-offs. And that makes it a bit tougher for, I guess, taking a clear trade or a clear directional trade for the market, and that's the big problem really. Of course, by the end of the week, it's been 5 straight days of losses now. that the market has seen. And if you look at the Feb series, it was a very weak series, not just for the index, but for the Bank Nifty. I mean, the Bank Nifty is now down about 4% in the Feb series itself. It's the biggest fall that we've seen since June of last year. So that continues to be the big problem pocket for the market. Yesterday as well, there was an attempt to recover, but not a convincing attempt from the Bank Nifty. The good part today is that the global handover is strong. So the Dow was up in the green yesterday, but lots of macro data comes out later in the evening. So my guess is that people may not want to take a bullish call based on the global data, because there's personal income data, there's consumer spending that comes out later in the evening. If that data is weak, then it could drag down global markets because, that piece has not worked very well. For our own markets as well, the Nifty, although it has been holding around the 17,500 mark, the 200 DMA is something that could be tested. That's what experts have been suggesting in the last few days. So the downside is still very real. And if you look at it, FIs have been selling quite a bit. So once again, the numbers have gone up. Yesterday, FIs sold about 1,400 crores. Put together in February so far, it is about a 3,000 crore sell figure that FIs have seen, a little over that. So the bias is definitely on the downside. Even if bounces come, they get sold into. They are not very durable rallies or pullbacks, and that seems to be the problem pocket for the market. So let's see how it goes today.
Well, that's right, Sonia. This market is prone to selling, and a fresh breakout will come only once we get past the 17,850 to around 18,000 odd. But I'll tell you what, when everything else fails, then turn your attention to history. And history suggests that in the last 20 years, Nifty has never had 4 straight negative months. I went through the data, and this is a derivation. I think in 2001 odd, that was when we had 4 negative months, but otherwise it's never ever happened. So the bulls, they are banking on either history or hoping for a late pullback in the next couple of days. You have a couple of sessions left in February, so they're hoping maybe we don't see 3 negative months itself. And just pull up the data points. December was a bit of a down month, January, and now we're bracing for a February down month. March, what does it hold? So either you don't want to see 3 negative months, or then you're banking on that we see 3 negative months and we see a bit of a pullback. And it's happened twice in the past. That's a recent past. In 2022, well, we had highlighted this even at that point of time, that we did see 3 negative months, and July was spectacular. If you go back to 2020 as well, that's from the COVID lows, you had 3 negative months, and then you had a good pullback. So when all else fails, turn your attention to history and hope that the bulls have something to cheer about. At the start of the series, well, the FI is a net short, and I always say that's not such a bad thing. And you're hoping at some point of time, maybe when the short positions get around 82, 83%, which we've seen in the recent past, we do get a bit of a bounce. For the time being, they're building on their shorts, and the shorts are at around 81% odd. On the call side, there was aggressive call writing. 17,500, 17,600 calls. Add that together, more than 60 lakh shares were added out there, and there was aggressive writing being seen at those levels, which brings us to the levels that you should be tracking. Yesterday, we got to around 17,620 and we got some selling, but going by the options data, in the vicinity of around 17,650, you're expecting some selling to come about. So 17,650 to 17,700, the near term, the bears would want to defend that. On the downside, yesterday we bounced off the 17,450 odd mark. So maybe if we get to that level, maybe in fact, you see a bit of a bounce on them. And you don't want to see the February 1st lows, but that's up for you in the screen. And that coincides with the 200 DMA as well. The SGX Nifty suggesting a gap up. It won't be a one-way ride. So expect some bit of volatility, but I'm counting on that data point. Never seen 4 straight negative months. Hopefully we don't see that.
Oh, absolutely. And the thing is with the banks, right? I mean, we were talking about how the Nifty Bank has sold off. This year, the Nifty PSU Bank Index is down 16% so far.
And it was a star last year.
It was a star last year. So, I mean, how the night changes. That's that song, right? So it's pretty much changed overnight for the PSU banks. But anyway, lots to track this morning. The Asian markets, by the way, are under a lot of pressure. Hang Seng is down almost 300 points. So let's get straight to some views for the day. We have Alexander Redmond of CLSA who says a correction in US equities is no surprise to them, as their year-end S&P 500 target of 4,000 is among the most bearish on the street, as they uphold that there is unfinished business for the US rate expectations, earning revisions, lead indicator erosion and unsettling geopolitics. He says their emerging market Goldilocks thesis for 2023 has not stalled. It has merely entered an air pocket in momentum. I like that.
All right, we'll get you some money market views as well. Bhaskar Panda of HDFC Bank says that the dollar index remained elevated as market participants continue to mull over a higher for longer rate cycle in the US, he says. Meanwhile, geopolitical concerns remain as Russia carries on its war with Ukraine. He adds Asia ex-Japan remains under pressure as a mild risk-off sentiment prevails. Given this backdrop, he expects the dollar-INR pair to trade in a range of between 82.6 to 82.8 to a dollar. For the day, he says, the RBI MPC minutes were on expected lines.
All right, and on the bonds, Bhaskar Panda says there was also some profit-taking by bond dealers in India. Generally, he expects the 10-year benchmark bond yield to trade in a range of 7.35 to 7.40% for now. It's not a bad morning of trade. I mean, the SGX Nifty is suggesting a start in the green, and it's a Friday morning, which can never be bad in that case. So let's see for our own markets. It's been 4 straight days of losses, 4-5 days actually, and the Nifty is just around that 17,500 mark. It's been hovering around that. We have our entire research team now joining in to help us prep for the day. So let's get straight to them. First up, the Z stock has been all over the place. There's an NCLT update that will come in as well. Nimesh is here to apprise us on the latest. Nimesh.
Hi, Sonia. So expect the Z stock to be volatile and the news flow to continue as well. So we saw what happened in yesterday's trade, big volumes and big intraday moves, and that is likely to continue today as well. 3 bits of news to track on Z Entertainment. First, last evening there was an official announcement from NSE that Z will be excluded from the FNO contracts from May. So the next 2 contracts will go on, and after that it will be out of the FNO series. Second, there will be 100% margin on the existing contracts. So it's basically like whether you're in FNO or in cash, it's as good as you're paying 100% margin. So that can have an impact as well. And the third, there is an NCLT hearing against the NCLT order which was passed 2 days back, where Z was insolvency plea was added for IndusInd Bank. So 3 bits of news to track, but I expect the stock to start in the red. But there could be volatility given that there is an NCLT hearing as well today afternoon.
Indeed, Nimesh, and you called it yesterday as well. Started in the red and ended way off the red. So we'll keep an eye out on Z. But Vivek as well is joining in to tell us about Axis Bank. They're nearing completion of that Citibank acquisition. Vivek?
Well, absolutely right. Good morning. So Axis Bank yesterday in a notification to the exchanges, has said that, all of the required approvals are on track. So both of the parties, both Axis Bank as well as Citibank, have obtained the requisite customer consents as well as approvals for the acquisition. And they hope to complete this particular acquisition by March 1st, 2023. In fact, Morgan Stanley has also reacted to this particular development. They're saying they continue to stay positive on a structural turnaround of the Axis Bank franchisee, and they expect ROEs to be 16% plus by FY24 and FY25. And also what they say is that valuations at 1.5 times FY20 price to book continues to remain quite attractive.
Okay. Sorry. Vivek, thank you very much for that. Now, Jindal Stainless, Hisar Jindal Stainless should be in focus, Nigel, right?
Well, that's right, because the record date has come about. They announced this merger between the 2 entities, many years ago, actually, a couple of years ago, and that's been progressing so slowly. But now, in fact, they've announced the record date. That's on 9th of March 2023. And if you're looking at the ratio, if you have 195 shares of Jindal Stainless, they'll be issued if you have 100 shares of Jindal Hisar. So just to say that again, if you have 100 shares of Jindal Hisar, then you'll be getting 195 shares of Jindal Stainless. And you plug in the numbers going by the current price. Pull up the Jindal Stainless price as well as the Jindal Hisar price. There appears that there is a bit of an arbitrage opportunity, because if you buy Hisar, it needs to catch up with the price of Jindal Hisar, going in that ratio of around 1.95 odd. So there is a 7.5% opportunity out there. So I'm expecting Jindal Hisar to outperform Jindal Stainless even today. Sonia, but you're tracking pre-call. There was a management call yesterday.
There was nothing different that the management said on the call that they didn't say to us. Yeah, it's the same reiteration. Pre-call is not in favor of any kind of hostile takeover, any kind of JV or synergies with Minda. And Minda Corp has assured that it will just be a 15.7% financial investment in Pre-call. Pre-call has said that they're not interested in any collaboration with Minda, no joint venture, no equity participation. And PHI Capital, which is the PE firm that has a stake both in Pre-call and Minda, they will continue to stay invested in the short and medium term. That's the assurance that they have given the Pre-call management. The buyback is not a prudent financial investment at this time. Remember, buyback was something that a lot of legal experts had suggested that could be the way out for Pre-call, by using the cash on their books to buy back more shares and prevent a hostile takeover. But Pre-call has decided against that, saying that it's not a prudent financial investment at this point in time. I reckon the stock will be in the green today, because if this entire hostile takeover doesn't go through and it's just a financial investment for Minda Corp, I think there could be some recovery in the stock today. But let's go across to Sonal now. She's tracking a couple of more stocks in the news. Sonal, over to you.
Good morning, Sonia. Oh, well, two stocks on my radar today. Let me start with Alchem because the company says that US FDA has issued an EIR, or Establishment Inspection Report, for their manufacturing facility at Indore. Remember, this was inspected from 1st July to 7th July last year, and the US FDA issued one observation with no data integrity issues as well. They put out all the details in terms of corrective and preventive action plan to the regulator as well. And now it means that inspection has been closed by the US FDA. So that's a positive news. KSB Limited reported numbers. It's a pumps manufacturer as well. Good set of numbers in Q3. Revenue growth of 18%, EBITDA up 36%. There's a margin expansion of around 200 basis points, leading to a profit growth of 44%. Expect these two stocks to be in the green today.
All right, so thanks very much for that. Now, Mangalam is standing by with Zomato, which is in focus. Mangalam, hi, morning.
Good morning. So it's Friday, we talk about food. Zomato has announced the launch of its pilot, which is Zomato Every Day, which basically is, home-style food, which is delivered to people on a daily basis at around 89 odd rupees. This perhaps has a little more traction than the pilot that it has replaced, which was of 10 minutes delivery. It is still a pilot, but the street may like the fact that they're looking at people buying more regularly than buying it just in 10 minutes. So this is something that we'll be watching out for.
Okay, we talk about food every day, not just on Friday. Mangalam, that's how we are, right? But let's go across to Surbhi now. Some more stocks that are in the news. Surbhi, over to you.
Hi, thanks for that. So today I'm tracking Sanofi India as they've declared their Q4 calendar year 2022 numbers. The numbers were pretty decent. The revenue was down 2.3% on a year-on-year basis, but their EBITDA was up 31% at 167 crores. Their margins came in at 25% versus 19% same time last year, and their net profit was up 45% at 131 crores. I'm also tracking SpiceJet as they have a board meeting that is scheduled today to consider issuing of equity shares via preference shares, and also they will consider options of raising fresh capital through QIP. This is subject to regulatory approvals.
Okay, thanks a lot for that, Surbhi. Well, just a quick recap of all the stocks we just focused on. Stocks with positive news flow include Axis Bank, Jindal Stainless Hisar, Precall, Alchem Laboratories, Sanofi India, SpiceJet, KSB, and Zomato. And only one stock with negative news flow, that's Zee Entertainment.
By the way, we'll talk more about food in 5 minutes from now because Gurmeet is with us.
I was just thinking, I'm so glad Zomato has replaced that 10-minute food delivery with this. It used to give me so much anxiety thinking that how much time will they take to cook it if they deliver it in just 10 minutes, right? So I think that was a plan that needed to be shelved, and I'm glad for the consumer's sake that has happened.
Absolutely. Rajat Bhattacharya is with us, Senior Investment Strategist at Standard Chartered. Rajat, good to have you with us here. Thanks very much. Quick thoughts, Rajat, on whether the US equities have more downside. Many believe they do. I mean, we had a call from CLSA earlier today. Their year-end target in the S&P is 4,000. In between, of course, they're expecting sharp swoons, etc. What is your sense?
Hi, morning, Prashant. Yes, this is what we've been talking about when we last met, right? So there was a clear sign that the Fed is probably going to hike further, and what we saw in the last 2 weeks is more strength in the US economy. So you started with the CPI data, the services sector PMIs, and then the retail sales, all beat expectations. So what has happened really is that all that talk about the recession, early early this year, that has been pushed back. So, if data is what we go by, and we can see more of the inflation data coming through today with the PCE inflation, if they are still elevated, then the Fed has more work to do, right? So as a result, there is more probably downside in the US markets. Now, what does that mean? Basically, you need to see the data, the job data, especially next week's non-farm payrolls is a key one. And we need to see that job market slowing. That's the first thing that Fed needs to watch. And underlying that is the wages inflation. That needs to peak before the Fed even pauses. So we need to watch those data very closely.
Okay. The big question back home here in India, of course, is that is there more downside for the Indian markets, right? I mean, when rates are moving higher, when inflation is high, growth is slowing down, there's a possibility of a recession. What should you be doing with your portfolio here? Should you raise cash levels? Should you stay defensive? What's the best approach?
Yeah, we're overall defensive as we've been, highlighting for the last few months in terms of the risk on, risk off. We have been risk off for a few months now, and that would be the position in India. But I must say that in India, it's a great time to buy bonds, and that is what it's not it's overlooked almost, because where the RBI is, maybe there is one more hike or maybe not. I mean, it's close to that peak, and where the rates are, real rates are positive in India. And if the RBI peaks, then it's a great time to add bonds. So that's what we're saying in globally as well, and in India. Bonds are priority right now. So anyone looking to put new money should be looking at the fixed income sector.
Hi, Rajat, you're sounding fairly cautious. Defensive bonds, what about equities then? You said there could be some more downside to US equities. You want to quantify that? What kind of a fall, could we probably see in the mother market? And what about the Indian markets? We've been underperformers, unfortunately, in 2023. Hopefully, we catch up soon. What's the downside there?
Yeah, the US market, Nigel, let's say the key level was that 4,100 for the S&P 500. It's been range trading around that 4,100 to 4,200. It fell below 40, but now it's just below 4,000. Again, bounced back yesterday. So that 4,000 to 4,100 is now the key level to watch. If it falls below that, we could see further 3 to 5% downside, and again depends on largely on the non-farm payrolls data next week, which will again decide what the Fed does in March. Are they going to go for a 25 basis points? We see increasing signs, increasing talk about even a 50 basis points hike if the non-farm payrolls are pretty strong. About your Indian stocks, they have a close link with what's going on in the risk sentiment worldwide. As I said, I mean, there's probably, we anticipated that Indian markets will not perform as well as the rest of Asian markets, and that underperforms might continue for a while given the excess valuations. But longer term, I mean, these are the levels. If anybody is underweight on India, they should be using any downside to average in, continue to average in, because the long-term story of India's earnings growth, GDP growth, all remains intact, and which is why you still see Indian equities trading at a high premium, I repeat, versus Asian stocks versus global stocks.
Okay, Rajat, we will let you go on that note. So got that loud and clear that anyone looking to put new money should be looking at fixed income, and equities maybe is not the place to be, especially this year. Thanks a lot for joining in. Hopefully that changes, at least for the equity market participants. For now, let's take a quick break. On the other side of the break, Gurmeet Chadha of Complete Circle will be with us. He'll help us through some stock ideas, some analysis as well. We also have David Lennox of Fat Profits for a discussion on the way crude oil has moved.
Welcome back. Hope you're having a good Friday morning. If you're a bull, you'll be happy to see at least some green on the screen. That's the SGX if you're suggesting a bit of green, a 60-point uptake. But Gurmeet Chadha, the managing partner and CIO at Complete Circle, joins us on the show. Hi, Gurmeet. Good morning. Thanks so much for joining in. Well, Gurmeet, let's talk about the top stock, Z Entertainment. Yesterday that one was under pressure. The valuations, everything has taken a bit of a backseat right now. What's your view on the stock? This dip that you're going to get into, and today because of trading angles as well, with the stock going to be moved out of the FNO, it's likely to be under more pressure. How would you approach it at around this 190 odd?
So, Nigel, it's always been a value kind of a play or a special situation kind of a play for a long time now. Since the merger with Sony was announced, I think the operating performance has been soft with both subscription and advertisement revenues being slightly subpar. And I think this recent development of IndusInd Bank going to NCLT will probably keep a near-term overhang. So, I think it's best to let this thing play out. Once this, anything which is regulatory, it's in a market like this, we have seen the moves can be very sharp. So something which has fallen 50-60% doesn't mean that it can't fall further. We've seen that with so many cases, and so my sense is, just wait and watch. Obviously, valuations are very, very undemanding right now. And what also surprises me is the quantum of the loan, which is about 83 odd crores, for which this has gone to NCLT. So I would want to see more management clarity on that than simply what they've offered so far.
Okay. Gurmeet, hi, welcome to the show, and pleasure having you in as always. You know what, we were just talking about how the entire banking piece has broken down in the last couple of weeks. In fact, this year, SBI has lost 15% of its value already. Do you think it's, as a long-term bull that you are, would you look at opportunities here in the banking space? And if yes, what are the stocks to watch?
So I think some of the concerns initially started with probably can there be a systemic risk with the entire Adani episode. And I think some of the FIs have highest ownership in banks. In fact, if you put IT in banks, that's like 70-75% ownership, which they have. So any exit there puts a pressure there. Also, I think there is some past experience with ILFS, DHFLs of the world, DS Bank, etc., creating a bit of a run in NBFC. So there is some which is like 3-4 years back. So I think a little bit looks like a little overdone to me. Also, all this concern of NIMs getting topped and deposits getting repriced, I think is getting too short-term and myopic. I think the bank credit growth looks sustainable. It may not continue at 20%, but I think it still could be very healthy double-digit. And I think these banks have become very reasonable. Sonia, look at SBI, for example. It's around book value. Even Axis, despite like 3-4 quarters now of sustainable expansion in NII and NIMs, it's still at about 1.7, 1.8. Plus, all of them have very good contingent provisions, which means that any future credit shock or rise in asset quality, especially in retail, because everybody is aggressive, will also have some cushion. So I think the next 2-3 quarters you will see a sustained growth in earnings. And I think it's the valuations are very, very undemanding. You can actually slightly bottom fish and look at some, maybe go level 2 in some mid-cap banks also. Likes of Federal or IDFC First, etc. Very undemanding valuation. So I think the risk reward is pretty favorable in my view.
The Nifty PSU Bank Index, I was just looking, is down 22% from the 15th of December high. I mean, that was the high point, and it's lost 0.25% of its value. SBI reported but that's the thing, right? SBI reported a super set of third quarter numbers. Stock is down 15% from that level. So, Gurmeet, I mean, that's the kind of market we are in, right? You've got to, will stocks react positively on small beats, or will they react disproportionately on smaller misses? It's been the latter over the last 1 month, 1.5 months, isn't it?
Absolutely, Prashant, and nothing new with PSU banks. Now, if you just go back last 10 years, whenever they got recapitalized, we saw a sharp movement upside, and then again moderated. Then you had some, as I said, issues starting with ILFS, because of which they have remained. So there's always a reason why. I've always believed market prices in India reflect if there is underlying concern. And the risk in PSU bank is always something coming up, right? Some out of the blue thing coming up. But as I said, for SBI in particular, I think it looks little overdone to me. It's completely in the the oversold zone. So I've never ventured beyond SBI in PSU bank, simply for the reason that you can have some accidents which is beyond what you can comprehend by looking at just the financials, right? So it's best to stay with there. And also now the book, if you see, Prashant, 6 lakh crore is home loan book. Look at it's more than 40 lakh crores. The mix of the loan has changed. See the digital initiatives they are doing. So I think the kind of credit underwriting now versus what was there, let's say 5 years, 10 years back, is very, very different and much better. So to give it just the same multiple what you were giving is also, I think, is unreasonable.
Okay. You know what? Just stay on, Gurmeet. We'll come back to you for many more stocks. I want to chat with you about the NBFCs, about defense, which has done very well. But in the meantime, let me also go across to Manisha Gupta. She'll give us a quick roundup of all the commodity market action that's taken place overnight. And then we have a guest joining us as well. Manisha, good morning.
Morning. Thank you for that. Well, we have seen some bit of an uptick coming back in case of many of these commodities. Crude oil prices, for example, continue to be quite volatile. We've seen another 2% of gain come in overnight, and this support comes in after Russia says that they are looking to cut further production cuts there. They have proposed a cut of exports from Western Post by up to 25% in the month of March versus February, and that clearly has been supportive, even as there has been a 9th weekly gain in U.S. crude inventories, and this now results to 60 million barrels being added to U.S. crude inventories there. The markets have seen some bit of a profit-taking, though, come in case of the metal prices. So steel, which was trading at an 8-month high yesterday of around 42.60 Chinese yuan per ton, has declined to 42.20. Having said that, most of these metals are still headed for a strong weekly gain here. Copper prices as well have seen a decline of 1% overnight. This is because the central banks are now signaling long periods of restrictive policy ahead. Firm US dollar also seems to be weighing on. Having said that, the inventories are still at multi-year lows. The Chinese demand is still on, and we have seen premiums continue to build into the spot markets.
Okay, thanks for that. Well, let's also get a handle on what's happening, in several pockets and how you should be approaching it. David Lennox, the analyst at Fat Profits, joins us now to talk about that. David, good morning and thanks for joining in. There are, of course, demand concerns with respect to crude, right? So we've seen a fall to about $80 a barrel now. There's a bit of a recovery that has come through. But what's the sense you're getting about which way crude could head? And in the very near term, what are the markers, both the floor and the ceiling for crude prices?
Look, certainly, yeah, we have seen demand being somewhat destroyed by the fears that the world is going to go into a recession, and really that's what's driven the oil prices down to where we've seen them currently. As we start to get used to the fact that perhaps there is going to be some form of recession or some form of slowdown that's going to occur, we have started to see member countries in OPEC and Russia are particularly popping up and suggesting that they're going to be quite comfortable in terms of cutting back production, and we would expect to see that same sort of rhetoric coming out of other OPEC members as well. So look, overall, it certainly has been the fear that we've seen with rising interest rates in the US that we're going to see a hard landing or even in fact a recession created, and that's what's driven the oil prices lower. Look, until such time as we can see the Federal Reserve indicating that they're going to pivot away from a hawkish stance, and there's certainly no sign of that at the moment. They've been really quite stern on continuing to lift rates. Until we can see that starting to come through, that change, I think the oil price is certainly going to struggle as to where it is at the moment. As any whiff at all that we're going to see a slowdown, we'll see demand destruction, and we've seen what that does to the oil price. In terms of setting prices, it's a bit of an awkward market at the moment. Prices have been all over the place, but generally to the downside. We are expecting in the short term perhaps to see a little bit further strength in the US dollar. If that's the case, then one would expect to see a corresponding weakness across the broader commodity space. So perhaps the oil price, Brent especially, testing back towards that $80 region wouldn't be out of the question in the short term. Over the longer term, we have got a more positive view, but you really do have to probably look beyond the end of this year to see that view coming into play, and we would be suggesting that the oil price would be able to retest $90 to $95, certainly early in 2024.
All right. Hi, David. Good morning. So, giving us a broad range near-term 80, and maybe, in the months to come, maybe we go back towards that $90+ dollars or barrel. But I'm more interested in the downside. I recall you had given us a broad range of 70 to around $100 odd. On the downside, where do you see it headed?
Look, as I say, if we do see any real sign that the US economy especially is slowing down significantly, and that's what the interest rate rises are designed to do, then that's going to cause the oil markets to really implode probably, and certainly get back towards that $70 region, which we've talked about. There's no doubt that we can see that coming if the market continues to deteriorate on the economic front. There is a counter to that, and that's been China. We have seen China now obviously moving towards a more normal covert economy, and that's given some flip to the demand side. But it certainly is the supply side that's going to be the governing director of where prices are going. If we see cuts coming out of OPEC because they're concerned about where that price is or how low it is, then that's going to help lift the oil price. But conversely, if we see the oil price starting to really rise, then we're going to see fresh production coming on stream. So look, overall, I wouldn't want to be an oil analyst at the moment. I think the prices are really quite volatile.
Okay, so let's go then according to what you'll be more comfortable on. What about iron ore and steel prices? Because of the China reopening and fears that there's going to be some bit of a shortage of supply, maybe from Brazil or even from Australia, iron ore prices have moved up quite well. And steel prices, I think it's clocking more than $650 HRC. Where do you see both those two? Give us a couple of levels.
Oh, look, certainly both steel and iron ore are going to improve going forward, and that is on the back of the China story. As we get further and further away or more normal into the Chinese economy operating, then we are going to see a recovery in those prices, and that's really what we've seen happening. Iron ore has been able to, over the course of the last probably 12 months, sustain some fairly bad news in terms of economic data and certainly China. And it hasn't really capitulated in any significant way. So that would suggest to us that there is underlying strength in the market, and that underlying strength is keeping those iron ore prices now well away from the $100 where we had seen it trading. So if that's the case, then we would expect we see more and more time pass and China becoming, let's say, more and more normal under COVID rules like the rest of us, then we would expect to see those iron ore prices continue to just firm up, but we wouldn't be banking our houses on it or putting our houses on it because there just doesn't seem to be enough strong momentum to push the iron ore price, say, towards $130 to $135 at the moment.
All right, David, thanks so much for stopping by, giving us your view on crude oil, which is a little bit tricky, and also your view on iron ore as well as steel prices. Appreciate you joining in. Well, let's go back to Gurmeet Chadha. Gurmeet, you heard what David had to say in terms of iron ore as well as steel prices. And yesterday, late in the day, we had this news coming in for NMDC that they're likely to get close to roughly around 1,000 crores odd back, because as of now, they were paying 20% on their Karnataka sales. That's going to be reduced to around 10%. It's good news for them. Any view on NMDC? Or we had the other piece of news on stainless steel, Jindal Stainless, they're going to be merged. View on the metal stocks, and if any, on both these two?
So, Nigel, I think on the NMDC thing, I think some of it probably was factored in. I think what market would like to probably, if you were to get constructive, is can they get additional, the balance 1,500 crores. That would probably lead to maybe 20-30% jump in earnings. So, as I said, you got to be tactical here. Jindal Stainless also, I think the next quarter is again likely. We have to take these companies maybe kind of cycles we are in, maybe quarter by quarter, especially in metal space. So I think the realizations for all the volumes were very good last quarter. And also I think the overall demand in the specialty segment, which is automotive and others, is likely to be better. So that can also be looked at. We like Mukund, which we have discussed multiple times, more for long term and like a turnaround with Bazaar stake being 74% now, reduction in debt, sales improving from almost 4,000 crores to 6,000 crores. And the big impact of interest reduction would come next quarter because the land sale proceeds came in January first week. So probably you'll see more impact coming from next quarter onwards. That we like more on a durable basis. The others are more tactical.
Okay, well, I do also want to ask you about the IT stocks and lots more. So we'll do one thing. We'll take a quick break. On the other side of the break, we'll also get some technical...
Back, we're with us here on Bazaar Morning Call. We're just racing to the pre-open session. 12 minutes to go. Anuj is here to run us through what he's making of things. Anuj, good morning.
Morning, Prashant. For starters, the FII exposure in index futures is at multi-month low. We're starting at 19% longs in March, which was 38% in Feb, and before that 57%, and before that 77%. But this has been a market in which the FIs have actually got the trend right, because this has been a very weak market and it's a sell-on rally market. Though overnight, global cues are slightly positive, especially the V-shaped recovery in NASDAQ and the bond yields cooling off from near 4. That should help. But today we'll find out if our market is actually internally weak, which is X of global cues. Though it might get some support from Nifty IT, which defended the 20-day exponential moving average. So Nifty relatively is less weak compared to Bank Nifty, which has been the weakest pocket. On the Nifty also, the texture has been firmly sell-on rally, and all the intraday pullbacks like yesterday are actually quite meaningless because they're happening only because of short covering. And my sense is we have unfinished business at the 200-day moving average of 17,362, which also coincides with the budget day low. And the index which is taking it there is the Bank Nifty, which really remains the weakest link for market, has been for some time. And all short covering moves like yesterday will be quite suspect. And the approach is firmly sell on rally unless you start to trade above 41,500 or thereabout.
Okay, the approach is firmly sell on rally. Yes, this is something that you were telling us yesterday as well. Thanks a lot, Anuj, for that. So despite there being perhaps some sort of recovery today, maybe that could get sold into. At least that's been the texture for the last many days. But let's get a view on that from our guests. Mitesh Thakkar and Shrikant Chauhan are with us. Shrikant Chauhan, as we know, is the Executive Vice President at Kotak Securities. Gentlemen, morning to both of you. Mitesh, let me start with you. Is this a sell on rally market? Does this continue to be that way? And what is the prognosis for today?
Good morning. We have been advocating as much that the market remains weak, negative, and I think any pullback strategies would be good selling opportunities. The only thing is that I'd be preferring a slightly stronger pullback closer to about 17,650 is where I think we would want to add on to our existing short positions. But otherwise, in case you don't get there, maintain your negative bias. And I think Anuj was highlighting the level of 200 average. We've been pointing that out as well. I think 17,350, 360 could be a target. Of course, 17,500 is a small pivot which needs to be taken care of. So broadly, I think, rallies should be used to sell into. And today, I think we'll get about 40, 50 point kind of a gap up. I think a bit more of 30-point rally. And then, you might look at exploring some kind of shorting opportunities, if not directly in futures, at least via the put options.
Okay, gentlemen, good morning. Shrikant, how are you? What's your view on the index? Is it similar to what Mitesh is pointing out? Sell rallies and broadly looks weak?
Yeah. Prashant, good morning. Yeah, I think, the markets are very clearly in the range. And till the markets are not crossing 17,620, which was yesterday's highest level, I think we are going to see range-bound sort of activity. And below 17,450, we can expect trending downward activity. So the important and the crucial level is 17,620 for Nifty. And for the Bank Nifty, the important level is 40,250. So we may see some pullback if we see the market is crossing these levels in the short term. But the broader pattern is still clearly indicating us that we should look for reducing position if there is any sizable pullback in the near term.
Okay, what about individual stocks? What are we looking at in terms of buys and sells this morning? Shrikant, you go first.
Yeah. Good morning, Sonia. I think, very clearly we should look for adding those stocks which are parallel to the broader pattern of the market. I'm going to say capital goods and engineering stocks, which are going to do well in the long run, and they are available at their important support areas because of this correction. So we like Cummins India, which is currently trading around some 1,600. There we are expecting stock to move towards 1,650. We can keep stop loss at 1,575 for the same. And on the other side, technology stocks, they are finding some selling pressure at higher levels. And yesterday we saw most of them close at the lowest point of the day. So in that, specifically HCL Technologies is on the radar, and there we are expecting stock to fall to the levels of 1,050. We can keep stop loss at 1105 for creating short positions on HCL Tech.
Okay. Mitesh, what about you?
I have a mix of buys and sells, and 2 buys to 2 sells. On the buying side is Coforge with the stop at 43.90 for targets of 44.80. And Muthoot Finance, it's been declining for last many weeks now, trading right at the previous low, which was made a couple of months back. So that's a buy with a stop at 940 for a first target of 990. On the selling side is IRCTC. Disclaimer, we have some put options positions over there. So on a mild bounce back of 4 or 5 points, let's say around 606, 609 range, IRCTC I would recommend going short with a stop at 620 for a target of 575. And Vedanta is a conditional sell. It's been holding the level of 301 for the last 2 days, and 300 is also an average level. So I think once it breaks 300, you should expect more decline. So sell below that with a stop at 307 for a target of 285 to about 283.
All right. right, Mitesh and Shrikant, thanks very much, both of you, for joining us. We'll take a break here. We'll come back. And it is, of course, time for the pre-open session. We also will have Balaji Subramaniam, Vice President at IIFL Securities. We put the focus back on Z